Good morning, traders. My name is Christopher Vecchio, currency strategist with Daily FX. Today is Monday, October 19th, 2015. These are your FX headlines as we turn the page to North America. And of course, all attention in the market right now is on the Chinese GDP data released last night. Aside from that main headline figure, which came in better than expected at 6.9% versus 6.8% expected, the rest of the data was more or less disappointing. He had industrial productions and fixed assets investments year to date dropping in terms of expected pace and relative to the prior. Retail sales are continuing to edge up, but overall, this data brings forward two questions: A, is it reliable? And B, is it calming enough to ease concerns over the recent changes in the Chinese economy? And while the market may be taking a slight relief rally here, Aussie dollar moving up on the day on the news 72.95 right now. I don't think this is anything that's going to completely sweep these concerns off the table. If it was, then we'd probably see actually the dollar firming up elsewhere a little bit more against the euro, against the pound, maybe even against something like the yen, as the market was bringing forward the expectation the Fed would raise rates. Of course, the Fed in their September policy statement did say that they were keeping rates on hold due to some of these exogenous issues that had cropped up, and Chinese market volatility in the month of August was far and away the main concern there. But as we head into today, it is a fairly quiet day for the U.S. dollar index and the U.S. dollar overall. We're looking at a pretty light calendar. NAHB Housing Market Index up at 1400 GMT, and Fed's lacquer speaking on education at 1600 GMT. Overall, these two reports today or events don't really carry the necessary weight to move the market. But when we look at the broader U.S. dollar index, it's also worth noting that recently we've started to make a little bit of a turn here. If we take the trend line from the recent lows that we had in August and in September, we are having a lot of trouble closing back above that line. But more importantly, we're seeing that right now the momentum profile has shifted lower. We've seen price undercut its most recent uptrend. Indicators have fallen back into that bearish territory, and now we've started to treat this daily 8 EMA as some short-term resistance. We've been below it since 10:05, and since then, on subsequent rallies back towards it, it's been more or less respected. Couldn't get anywhere near it on 10:08, failed to get out to it on 10:13, and overnight was more. So we'll be watching this daily 8 EMA. Now that we've breached the downside level from that mid-September swing low, it's possible that we are getting ready for the next swing lower here. And when we look at the markets right now, indicators still in bearish territory. Stochastic's just pushing through the 50 line, but we're starting to get that compression. We get the next move lower in the dollar index. We get those sell signals. We're looking for an immediate return back towards last week's lows. Euro dollar here is a little bit of a more complex situation, and so if we were looking for the US dollar index to really move in the next few days, it'd probably come from, say, the pound or Aussie dollar. But the euro with the ECB this week is a little bit of a trickier situation. Now, given some of the peripheral concerns around the eurozone, low inflation, falling inflation expectations, continued weak energy prices, on a year-over-year basis, a euro that's strengthening, there's now concerns that the growth and inflation outlook for the next few years may still be too optimistic, and if that's the case, the ECB is going to need to do more sometime very soon. So for now, even though U.S. economic data isn't in the greatest shape, it's actually gotten a little bit worse over the last few weeks. I think the main picture for the euro is whether or not the ECB is going to signal its intention to ease, and if it does, it really keeps a cap on euro-dollar rallies. We've already seen since the September FOMC meeting that the market's more or less priced in more risk or more risk-taking around these central banks keeping rates lower, introducing more easing. Euro Aussie itself through the end of last week had fallen by 7.5% through the end of, or since the end of the FOMC meeting on September 17th. And as of now, you have euro dollar here kind of trading around sideways. So as we look into everything that's going on in the market, despite this perceived notion that the Fed wasn't going to be raising rates, euro dollar still hasn't gone anywhere. And it's this counterbalance of the ECB's suspected action forthcoming that's keeping euro dollar pinned lower. So we'll be keeping an eye on this more over the course of the week. Euro crosses maybe setting up for some further weakness, in particular, say euro pound, euro Aussie, euro Kiwi, definitely worth keeping an eye on. Also worth keeping an eye on today, Canadian elections. While we're not expecting a major reaction in the Canadian dollar, it's worth noting that the government stance the last few years, much like many of the governments across the developed economic world. Fiscal policy has played very little significant positive role. It's probably been a handicap to growth rates in some of these developed economies like the United States, like Great Britain, like Canada those last few years. And so, even though we have the likelihood that this government remains in power, if there is a sensitive shift in power to one that favors more liberal spending policies, per just financial rate theory, when we look at what's going on with I believe it's the Mundell-Fleming model, we can peg the impact of expensive fiscal policy to an appreciating currency over time because it helps boost aggregate demand over its current expected levels, thereby helping boost inflation, necessitating a central bank to hike rates. So if we see a new government coming to power today, one that favors, again, more proactive stimulus measures on the fiscal side of things, it may in turn diminish the need over the long haul for the BOC to ease policy as the economy grapples with a recession, and therefore could help stem the tide in the Canadian dollar. Of course, that's a much longer term thing we're going to have to keep an eye on, but the seeds of that move could be sown. Again, Canadian elections today, keep an eye on that. That's it for me. I'll be back later on with another video. You can always find me in the morning, Daily FX on Demand, 6 to 7 Eastern, 10 to 11 GMT. You can reach out to me through the Daily FX real-time newsfeed, stock, Twits, and Twitter at CVecchioFX, and you can always email me, cvecchio@dailyfx.com. If I don't speak to you before then, good luck trading the next few days.